All right, well, June's non-farm payrolls coming in softer than expected. The U.S. adding 209,000 jobs last month. While it's below expectations, the reading reinforcing the narrative of a resilient U.S. economy. But can the latest jobs data move the needle for the Fed? We want to bring in Paul Gruenwald. He's S&P Global Economist here to discuss more on this. Paul, coming in weaker than expected, still above 200,000, right. Enough to guarantee that the Fed's going to keep hiking?
Yeah, I think so. I mean, it's a little bit lower than expected, and I guess for the first time in 15 months, we got a lower than expected number, right. But it's still over 200,000. The unemployment rate is 3.6. Wage growth ticked up. So if you put all that together, it's a mixed report at best, but I don't see how this changes the expectation that the Fed goes 25 basis points later this month.
Did it surprise you, the number coming into this? I mean, I know that expectations had ratcheted up a little bit given the ADP numbers yesterday, but did the numbers surprise you at least a little bit?
Yeah, a little bit, especially, right. ADP yesterday was, what, 489?
Nearly 500,000,
it was a huge
yeah.
number, so I think everyone was expecting the report this morning to come in a little bit hotter. Again, I mean, it's moderately good news, but I think it's not big enough to move the needle. And it's really the wage growth, too, right? If we're thinking about monetary policy, big debate amongst economists, what's the unemployment rate that's consistent with 2% inflation? Does it have a 3 handle or a 4 handle? I think it almost certainly has a 4 handle. So we need to get that unemployment rate gradually up, but the wage growth is going to be a challenge for the Fed.
So what does that mean just in terms of how high rates are going to be, that higher for longer narrative that we're starting to hear more and more about? And beyond that rate hike possibly later this month, what do you think is the potential here for a second rate hike?
Right. So we're in the higher for longer camp. We just put out our credit conditions reports last week. So I think a couple of things have happened. One, this cycle, the Fed's been kind of leading the market, right? In previous cycles, we had the Greenspan put, the Powell put, the whatever Fed put. This time, the Fed's kind of dragging the market closer. But what we've seen is if you look at the end year expectations for where the market thinks the Fed's going to be, they're now in the low to mid 5. So the Fed's kind of convinced the markets that they're going to raise rates and stay there. Whether it's one more or two more, we really need to start seeing some more cracks in the data. So if you look at unemployment, we've been 3.6, 3.7 all year. PCE core inflation, which is what the Fed watches, that's been stuck at 4.6, 4.7. So we're just not moving on the numbers that need to move.
So does another hike then position the unemployment number to hit that 4 handle that you're expecting?
Yeah, it's a question of how it hits the 4 handle, right? The sort of higher for longer view is that we don't have a recession, but we kind of, slowly ratchet growth down. If the unemployment rate drifts into the low to mid 4s over the next couple of quarters, that's going to be a win. Inflation sort of drifts down into the 2s. That's the soft landing scenario. But again, we're not seeing much action on those numbers that need to move. We all know monetary policy moves with a lag. But I think one more is definitely baked in for the Fed. And do they keep going after that? I mean, the Fed said 2 in the latest statement. So we're in the kind of 1+ camp right now.
What do you think of that wages number? You mentioned the fact that did come in above expectations. Clearly a very important data point for the Fed.
Right.
I guess, how is the Fed looking at the fact that inflation or wages consistently are so persistent to the upside here, and what that really tells us just about how long this fight to get inflation under control, what that timeline potentially looks like?
Yeah, I mean, the timeline's a big question, right? Yeah. So if we think about the golden path for the economy, inflation's 2, we've got full employment, growth is maybe in the high 1s, just below 2. We want to get onto that path, right? We're above the path now. We know that because inflation's too high and unemployment's too low. If we get onto that path abruptly, that's the recession scenario, right? We get some negative or sharp downturn in growth. So they're trying to guide it onto that path over many, many quarters. So there's a lot of tailwinds, right? You guys have been talking about it on the show. So that suggests we might be able to, land it a bit more softly than some people think.
That 2% target, though, from the Fed talk, and we heard some Fed officials weighing in on the fact, but there's been discussions about maybe we should raise it. Maybe it should be more in terms of 3%. Does that make any sort of sense to you?
I'm in the hardcore camp on this one. And I think, first of all, traditional is, right, the old guy thing. But, if you say low and stable prices, that means people don't think about inflation on a day-to-day basis. It's not really part of the wage setting formulation. So that's been codified at about 2. I agree that it's more difficult to get inflation down from, let's say, 3 to 2 than 5 to 3. But if you think dynamically, that's not going to work, right? Because if you say this time, well, let's throw in the towel and settle for 3. the next time we get an inflation burst, it's going to be hard to get it down to 3. Maybe we'll throw in the towel and get it only down to 4. So we have this kind of, we have fancy terms for everything in economics, dynamic inconsistency, right? So we ratchet higher. I think it's worth the effort to get inflation back down to 2 because I think that's kind of better for everyone over the longer term.
So speaking of worth the effort, then how many basis points are you expecting in this month? Are we looking for a 25 basis point hike?
Yeah, I think we're done. I mean, hopefully we're done with the 50s and 75s, or even Canada had 100. But I think we're in the 25 zone. But again, there's a big question mark about how much of the tightening needs to still filter through. If you look at real interest rates, they're not that high. If you look at financial conditions, they're not that tight. So there's this sort of pointing to the fact that we need to do more. But again, all these hikes over the last, 5 quarters have to work their way through. The good scenario is we let the air out of the balloon softly, we get away with 1 or 2 more, but I don't think that's a done deal yet. We got to wait for some more data on the labor market.
You still think there's odds of a soft landing, right?
I think that's probably, unless the bottom really falls, the hard landing scenario is one where the bottom falls out of the labor market, and today shows that that's probably not in the cards in the near term.
Yeah, labor market extremely resilient.
Yep.
All right, well, Paul Gruenwald, S&P Global Ratings, Global Chief Economist, thanks so much.
Thanks very much.